The S&P 500 is up 11% year to date. Many of you guys have likely had an amazing year. For me personally, I'm up 30% year to date. Last year, I was up 54%. So I've been having a great year. But I don't know about you. But for me personally, I believe AI is kind of getting a little bit hot. I mean, whenever someone like Tom Lee buys a $20 million stake in some kind of a stock and it goes up 4,700% in one day, and you have so many things going on with a lot of the AI stocks, I believe AI is getting hot in general, and I own many of those growth stocks, and that's how I'm up 30%. So for me personally, I'm starting to look into stocks that are a little bit outside of tech, outside of mainstream media, outside of popularity, stocks with bad sentiment, and stocks with a very wide moat quality companies, but they're not as involved in the whole AI thing as a lot of companies are. And I think it's a good way to diversify away from tech a little bit. And I think this is something that you might like as well. And I'm going to share two ideas today. I have a position in both of them, so I'm going to talk about them. And then I have a much better idea on Sunday that I'm going to publish and talk to you about it. So I really hope you enjoy it as always. Now, the first stock, which I talked about before, and I'm going to talk about it again, is Copart. Copart, I have call options on the stock going into 2027, but the stock is down 14.5% year to date. Very different from the S&P 500 and the Nasdaq. Copart is an amazing company, but you could look at earnings per share, how rapidly they compounded earnings per share, and it's been very steady. It's amazing for Copart. But Copart makes money in two main ways. The first way they make money is the services revenues, and the second way they make money is within vehicle sales. Now, Copart owns a lot of auctions and a lot of the junkyard, salvage yards, you could call them. So whenever you have a car that's totaled, it's beyond any repair as deemed by the insurance company, it would go to the junkyard or it would go into the auction. Copart has a 45% market share in the United States in terms of auctions, and they own their own land, so they own the real estate. Their competitors do not own the real estate. Now, for the vehicle sales, sometimes a lot of cars go to the junkyard. They're actually in great conditions, but they are not great conditions in US standards. So they sell those cars internationally. This business has declined 4%, and it was mainly because of some tariff problems and other kind of seasonality within the insurance business. But this is one of them. Now, the biggest part of their revenues, which is the most important one, is the services revenues. Services revenues is like a high margin kind of recurring revenue business model, and it grows 7.1%. And I use a little bit of help from ChatGPT to show you the business of Copart in terms of services. And they collect many different fees. The seller fees, which is, for example, the insurance company, they collect on storage fees. So whenever the car sits too long in storage, they collect a fee on that. They collect an auction listing fee whenever they list them on the auction. They collect a towing pickup whenever the car it has to be picked up. Copart picks it up and they charge them a fee. Then they charge them fees for cleaning, title processing, yard management, other kind of things. Now, the buyer is also paying fees. They have to pay a transaction fee whenever they are buying the car from the auction. They have to pay an internet bidding fee because it's mostly online. They have to pay a membership fee for them to even be able to bid on the auction. And then they have to pay a gate fee whenever they come to pick up the car. So again, the business model is amazing. And this is why Copart has 33% net income margins. If you want to compare it with other tech companies that are well known, you look at maybe Meta. Meta has 40% net income margin. Then you have Microsoft at 36%, and Copart is at 33%, which is higher than Google's net income margin and higher than Apple and even higher than Amazon. So you can see how profitable this company is. It's as profitable as a mega cap tech company, and it's not really a tech company. It's mostly a salvage yard, but the fees on those are so huge and the profit margin is so wide that they have margins higher than Google and comparable with a company like Microsoft. So this is not your average junkyard company that's unprofitable or it's just like a value investment. No, it's a high quality company. They have compounded earnings per share for many decades. It's one of the best performing stocks ever, and I think they're going to continue to do so for a very long time. Now, in terms of the latest report, revenues increased 5.2%, which was lower than expected. And I told you why, which was due to a decline in vehicle sales. But because vehicle sales declined, a lot of the vehicle expenses declined also, which is the low margin stuff. And it has allowed them to expand net income margin and expand profits in general, which is why net income grew 23% and earnings per share grew 24.2%. This is massive growth for a company like Copart, massive growth. Normally they grow 12, 13% on average. Now they grew 24% in earnings per share. So that was an amazing quarter. I'm not sure how sustainable it is, but 24% is pretty amazing, again, from a company like Copart. Now, in terms of Copart in general, is again an amazing company. They have 26% return on invested capital, so very high return on capital for Copart. They have a very good balance sheet. They have almost $5 in cash, $4.90. So you're paying for Copart around $48 per share. Out of the $48, around $5 is in cash. So you're not really paying $48 for the business. You're paying like $53 for the business. So the business, again, has a very good balance sheet, no debt, and have $5 per share in cash. Copart also owns a lot of real estate, so they very rarely buy back stock. They pretty much never do dividends, and they just like to reinvest the capital into widening their moat, buying real estate. They're expanding in foreign countries, a lot of places in Europe and in Asia, to do kind of the business model over there and expand the modes. They're buying real estate, buying storage facilities. So this is why they invest a lot in real estate. And if you're buying Copart, you're getting $3.6 billion in real estate, which most of it cannot be replicated because most people don't want a junkyard in their backyard or somewhere close to them. And it's hard to get permitting to kind of build those things. So whatever is there is going to be there forever. And Copart has $3.6 billion in prime real estate. Now, if you look at the valuation of Copart, this is the biggest mental barrier with this one. And it took me a while to analyze it and be comfortable with it. But Copart is trading at 28.4 times earnings, which might seem extremely expensive for the business. And the best way I would put it for Copart is you're not really paying 28 times earnings because the company, again, has around $5 in cash per share. So if you take out the $5 in cash per share and you run the numbers on $1.80 of earnings per share, which is what it's expected, for Copart, you're paying around 23 times earnings. You're not paying 28 times, you're paying around 23 times, which is where the stock bottomed pretty much in 2022. I don't believe this is expensive for a company that has been growing earnings per share, 24%. Maybe it's not sustainable, but they can at least do 12, 13% in my opinion. For a company with net income margins close to Microsoft, 33%, with such a real estate position, such wide moats, with $5 in cash and no debt, 23 times earnings, for me personally, is really not expensive at all. And my main bet on Copart is it's likely going to return back to its historical average or a little bit higher, to around maybe 30, 31 times, I believe by mid-2026, especially if the AI hype kind of dies out a little bit and you have some more inflows into the market in different sectors. Now we're seeing it with healthcare, and there's many boring stocks that could potentially benefit from whatever's happening in AI once it cools down a little bit. I think Copart could be one of those stocks. And after that, so I would see maybe 20, 25% in the near term in terms of upside, and then 12 to 13% annual return for the next 5, 10 years, as long as the company can keep growing earnings per share 12 or 13%. And this is my thesis on Copart. And of course, you could do your own research and research the company, but this is what I have with Copart. The second one is a very hated stock, actually. And every time I talk about the stock, people tell me, I loved the video, but you lost me when you talked about it. And then the stock goes higher. And then I do another one. They say, oh, but you lost me when you talked about it. I really don't know why the company is so hated. It's also some kind of a tech company, but the sentiment is so bad, the valuation is so low, that this is one where it doesn't really correlate with AI. And if you go back to March, April, the stock was actually holding up very well whenever the market and a lot of the AI stocks were declining. And this stock was Uber. Uber is up 35% over the last year. I've been talking about it from the $70 range. And every time I talk about Uber, I say, oh, but you lost me on Uber. You lost me on the stock. Uber has no moat. Tesla's going to kill Uber. I always kind of get those things, and then the stock goes even higher. But I'm going to explain all those things in today's video. And again, you could go back to March, April. Uber, especially year to date, if you look at it and you go back to, let's say, March, April, Uber was holding up much better than the overall market. And it wasn't even negative on the year. And, it just doesn't correlate too much with AI. But Uber, people have a bad memory around this one. Because back in 2019, the company was losing money. They were losing like $5 billion a year in cash flow. Now the company is completely different. They're going to make $9.2 billion in cash flow. So they went from losing $5 billion to making $9.2 billion in cash flow. It's a completely different company. The company is growing revenues 18%. It's not some kind of mature company. And the revenue growth has been reaccelerating from 17 to 18%. So 18% revenue growth, adjusted EBITDA is growing 35%. And they have been expanding EBITDA margins successfully. Now, if you want to look at the scale of the business, the company has 180 million monthly active users, 180 million people. This is insane. The amount of monetization you could get out of 180 monthly active users is insane with a company like Uber. And by the way, I'm using Fiscal.ai to come up with this chart and all those charts that I showed you. And if you want to try it out, they give you 2 weeks of free access if you want to use my link down into the description. But out of the 180 million people, 36 million people are subscribed to Uber One. And Uber One is like a subscription where you get potentially free delivery. It's not free, but you get certain benefits with Uber One. But those are like the loyal people with Uber. And there are 36 million members. So you could see the brand loyalty to Uber. Uber became a household name. Most people, they don't even say taxis and cabs anymore. They say, call an Uber. I'm going to get an Uber, especially in the United States. It's a kind of became a household term. Like I'm going to Google something, say I'm going to Uber somewhere, or I'm going to call an Uber. They don't even say taxis anymore. So this is what Uber really is. And the biggest advantage for Uber, in my opinion, is the delivery business. The delivery business has been stunning. And the growth over here is, again, reaccelerating. Gross booking went from 17% growth, 18%. Now gross booking is growing 20%. Revenue growth is growing 23% in deliveries, 23%. And this is a trend that's not going to stop anytime soon, guys. Even when we have drones and autonomous drones and all the kind of things, all those things will likely be on Uber platform, and Uber is going to benefit from them. That's just the way it is. Adjusted EBITDA has also been expanding with the business. It used to be unprofitable a few years ago. Now there's a 4% EBITDA margin. So again, Uber is a very different company from what it was. And I believe the delivery business is really mainly, at least for now, is shielded from the Tesla competition that everyone is worried about, that Tesla is going to kill the Uber business model. Well, yes, maybe Tesla will take a lot of market share from Uber in the United States. This is very possible. But how about the delivery business? Are we going to put in some kind of a humanoid in a Tesla that's going to go up the floors and deliver, food to your apartment or to your hotel room? That's not going to happen anytime soon. So we still need, human drivers, at least for delivery. And once we have drone companies, they will likely be on Uber platform. And it could be even more profitable for Uber this way. But the delivery business, they're not going to take over delivery anytime soon. And Tesla does not have such an edge outside the United States because, again, here we have the tax credits, or I should say the tariffs, that are protecting Tesla. But outside the United States, you have Chinese competitors, you have competitors from all over, much more competition in Europe, for example, and other places. And a lot of those competitors, let's say, for example, AV Ride in Abu Dhabi, they're partnering with Uber. So again, Uber has an edge outside the United States. And if Tesla could affect Uber, is it going to take Uber to zero? No. But this is the main narrative that has been and is still waiting on the stock. And that's why I still like it here very much. But Uber has recently partnered with Lucid and Nuro to launch a lot of autonomous vehicles where Uber directly kind of controls those vehicles. And Uber put a $300 million investment into Lucid, which I believe was a very smart idea. And this is something that Uber does all the time. They own a stake in Lucid. They own a stake in Didi, which is one of the largest delivery and operators in China. They own a stake in Grab, in Aurora, which is making, I believe, autonomous trucks, Joby Aviation, which has the flying taxis and flying cars. They have stakes in a lot of key companies, and one of them is going to be Lucid. And Uber intends to potentially have more direct control over a lot of those autonomous vehicles. And they also want to have stakes, equity investments in a lot of different companies. And the company, again, is flooded with cash, and they have massive cash flow, and they have no dividend. So they're putting 50% of the cash flow to do buybacks, and the other 50% to acquire stakes in companies and build up the autonomous investments and many other things. Now, this is what Bill Ackman said about Uber. Bill Ackman, if you don't know, he owns Uber. And this is not from me. This is from Bill Ackman. And this is very recently. And Bill Ackman said, "We continue to believe the market underappreciates the durability of Uber's moat, the magnitude of its earnings growth, and the strategic role it will play in shaping the future of mobility. We anticipate Uber will generate 30% or greater in annual earnings per share growth over the medium term." And this is Bill Ackman, and I believe he agrees with what I'm saying, that even though the stock is up a little bit, it's still extremely undervalued. And the reason for that is because Tesla is going to kill the Uber business model. And I just explained to you why I believe this is not the case. And if we're right on that, we're not only going to get a potential 30% in earnings per share, we're also going to get a potential multiple expansion, which is an amazing combination. And it was, again, more attractive before, but I still believe it's attractive now, which is why I still own the stock for Uber. But if you look at the company's price to free cash flow, which I believe is a more accurate metric because of their equity investments and a lot of the gains they could have from that. So I like to use cash flow. And if you look at, the price to free cash flow, it's trading at 19 times cash flow. I was talking about it at 15 times. 19 times cash flow is still dirt cheap for a company that will likely grow free cash flow per share, which the analysts are expecting 33% this year, then 18%, 16%. And the analysts have been consistently wrong. They were expecting 18% cash flow growth this year. It was 33%. Next year, they expect 18. I think we will likely grow 20% plus for many years to come, which would mean that you're paying less than 1 times price to free cash flow growth for a company like Uber. I mean, I could see Uber going back to 23, 24 times, 25 times, whenever the sentiment finally changes that autonomous vehicles will not kill the Uber business model. And then you're getting earnings per share growth of 30% or free cash flow growth of around 18 to 20%. So I still believe Uber is a very interesting setup over here. I believe Copart is a very interesting setup. And now I'm putting, disclaimers because, I've been getting a lot of comments where I talk about a stock, it goes down 3%, and I get blamed because I talked about it and the guy lost 3% or whatever. And I'm just saying, guys, I buy those stocks with a long-term horizon. So when I talk about something, I'm talking about it for the next 3 to 5 years at least. So if the stock goes down tomorrow for me, like let's say Uber goes down 10% tomorrow, it's good news. I get to buy more at a lower price if the fundamentals are intact. So if the stock goes down, to me, it's good news, especially if I like the company. And I just, do your own research. And that's all I have to say for today. Hope you enjoyed it. Not financial advice. And if you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.